You have $1,000 to invest. You find MetroCoffee, strong brand, 10% dividend. That's $100 per year. It is just $15 a share. You check the stock chart. You buy it. 1 year later, the dividend is cut and your $1,000 is worth $600. An intelligent investor starts in a different place, not with the chart, not with the dividend, with the balance sheet. As the legendary investor Peter Lynch said, the biggest losses in stocks come from companies with poor balance sheets. Hi, I am Nick, the guy with the Greek accent, a long-time value investor with an obsession to getting this right. In this video, I'm going to show you exactly what intelligent investors look for in a balance sheet and what MetroCoffee's balance sheet was quietly telling you. The balance sheet answers one question. What does this business own and what does it owe right now? Not over a year, not over a quarter, one specific day, a photograph, everything frozen in a single frame. The balance sheet is divided into two sides. The left side shows assets, everything the company owns. Cash in the bank, equipment, property, money owed by customers. If MetroCoffee sold everything tomorrow, assets are what they would put on the table. The right side tells a second story, how the company paid for all of it. It shows two things, liabilities, money the company borrowed, and equity, money the owners put in. Every asset was funded somehow, either through borrowing or through the owner's capital. The balance sheet is at the same time a photograph of what a business owns and a receipt for how it paid for it. One thing to keep in mind, most numbers on a balance sheet are estimates, approximations made by accountants following rules that allow for judgment. The balance sheet is not the truth. It is the closest version of the truth that accounting can produce. Download the free MetroCoffee case study from the description and follow along. By the end, you'll know exactly how to spot the red flags. Now let's go deeper into each side, starting with assets. An asset is anything the business owns that has value. Assets are divided into two categories. Current assets come first. These are anything the business can convert into cash within 1 year. Cash itself, $40 million sitting in the bank. This is the one number on the entire balance sheet that it is almost impossible to manipulate. Money in the bank. When MetroCoffee reports $40 million in cash, that number is about as close to truth as accounting gets. Inventory, $50 million. Everything MetroCoffee has purchased but not yet sold. Coffee beans, syrups, pastries, sitting on the storage waiting for a customer. Already an estimate. Different accounting methods value inventory differently. Accounts receivable, $30 million owed by clients who haven't paid yet. The sale has been recorded. The cash hasn't arrived. And the number is an estimate. Not every client will pay. What appears on the balance sheet is the accountant's best guess at what will actually be collected. Add those three together and you get $120 million in current assets. Then come the long-term assets, things the business owns and that will provide value for more than 1 year. For MetroCoffee, that means property and equipment, the 3,000 locations, the espresso machines, the refrigeration units, original cost, $370 million. But the balance sheet shows $250 million. The difference is accumulated depreciation, $120 million. Here is what that means. Assets wear out over time. An espresso machine bought for $10,000 doesn't last forever. So instead of recording the full cost on day one, the company spreads it over the machine's useful life, say 10 years, at $1,000 a year. Accumulated depreciation is the total of all these deductions across every asset MetroCoffee owns. It is not cash leaving the bank. It is the balance sheet aging its assets on paper, and the useful life, 10 years, 8, 15, it is an estimate. Then there is the $130 million in right-of-use assets. MetroCoffee doesn't own most of its 3,000 locations. It leases them. Under modern accounting rules, a long-term lease must appear on the balance sheet as an asset, the value of the right to occupy those spaces. And because that value depends on future payments that haven't yet happened, it is an estimate. Long-term assets total $380 million. Current plus long-term, $500 million, or more precisely, $500 million as estimated by accountants on one specific day. Cash is the exception. Everything else is an approximation. Now we flip to the right side, liabilities. Everything MetroCoffee owes. Same structure. Current first, long-term second. Current liabilities are obligations due within the next 12 months. Accounts payable, $60 million. The mirror image of accounts receivable. MetroCoffee owes money to its suppliers for coffee beans, packaging, ingredients delivered but not yet paid for. Every business runs on this 30 to 60-day payment cycle. Current debt, $40 million. Not all MetroCoffee's borrowing, only the portion due within the next year, the nearest installment on a much larger obligation. Total current liabilities, $100 million. Long-term debt, $120 million. Loans and bonds that don't come due this year or next. They sit quietly in the background, which is exactly why most investors scroll past them. Lease liabilities, $130 million, the other half of the right-of-use asset. When MetroCoffee recorded its leased locations as an asset, it also recorded the obligation to pay for them as a liability. Same transaction. Both sides move together. The assets say, we have the right to be there. The liability says, and we will be paying for it for years to come. Total long-term liabilities, $250 million. Current plus long-term, $350 million in total liabilities. Liabilities are more straightforward than assets. What a company owes is a matter of contract, a loan, a lease, an invoice. Less room for estimates. But the question is never just what it is owed. It is whether the business can pay it. And that leaves equity. $500 million minus $350 million. $150 million. The owner's stake. What would remain if MetroCoffee paid off every debt today? Two lines. Common stock, $50 million, the original capital shareholders put in, and retained earnings, $100 million. Every profit earned since founding minus every dividend ever paid out, the accumulated score. Total equity is also called book value, what the accountants say business is worth once every debt is paid. Not what the market says. Those two numbers are often very different, and because book value is built on estimate, it is itself an approximation. Assets is equal to liabilities plus equity, always, without exception. $500 million equals $350 million in liability plus $150 million in equity. The left side and the right side balance because they have to. Every asset was funded by either borrowing or by the owners. The receipt always matches the photograph, even when the photograph is an estimate. Just from this quick read of the balance sheet, an intelligent investor has already found a lot of reasons to say no. Just one striking example. Total equity is $150 million. Divide that by the number of shares outstanding, $100 million, and you get book value per share of $1.50. That is what each share is worth according to the accountants. The stock is trading at $15. 10 times book value. You are being asked to pay $10 premium for every dollar of accounting value built on estimates. But we are here to learn. So let's keep going, because buried inside this balance sheet is the number that makes everything worse. That number is long-term debt. Has it been growing? For that we have to look at more than one balance sheet. Remember, a single photograph tells you where things stand. Multiple photographs tell you where things are going. 4 years ago, long-term debt, $60 million. 3 years ago, $75 million. 2 years ago, $95 million. Last year, $120 million. Doubled in 4 years. Every year, same direction, growing. But let's not just eyeball the trend, let's measure it. Benjamin Graham, the father of value investing, used a simple ratio to test whether a company's debt load was acceptable. Debt to equity. Total liabilities divided by total equity. Graham's rule was straightforward. For a defensive investor, that number should not exceed 1. The lower, the better. MetroCoffee. Total liabilities, $350 million. Total equity, $150 million. Debt to equity, 2.33. Graham would have stopped right here. The company is carrying more debt than he considered acceptable for a safe investment. Graham developed this rule to protect ordinary investors, people with no Wall Street education, no Bloomberg terminal, no insider access. He wanted anyone to be able to use it, and now you can, and so can the people you care about. But we are not here to blindly apply rules. We are here to understand risk. Debt is not automatically a problem. A company can borrow to expand, to build, to invest in its future. But our job as investors is not to find exciting stories. Our job is not to lose money. Debt is the first number I turn to when I analyze a company. Debt is what kills companies and our capital. And when it grows every year for 4 consecutive years, I need to know one thing. How many years would it take to pay it off? To answer that, we need to know how much this company actually earns. Not what the headlines say, not what the dividend suggests, what the income statement actually shows. This is exactly what we open in the next video. I'll see you there.